Hello, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets. Also in the room is my colleague Victor, and we will be presenting the live market analysis webinar as we do every Tuesday. So for those of you who have joined us live, welcome to this webinar. For those of you who are watching a recording of this, please consider joining us live next time so that you will have the opportunity to ask us questions live in this room. Now, obviously, we'll be talking over the charts in a minute or so, but before we do that, please take a moment to read the disclaimer and the risk warning. So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So just a quick reminder, this webinar it takes place every week at 11:30 on Tuesday, London time, and it's mostly a technically focused webinar on the major FX pairs, gold indices, and cryptocurrencies. We do touch on fundamentals as well, and there will be a Q&A session at the end. Starting with the fundamentals first. So this week is going to be important insofar as the markets are concerned because we have the US non-farm payrolls report on Friday. We also have a couple of other potentially market-moving events, including the OPEC Plus meeting and some very important macro data elsewhere. Now, insofar as the NFP is concerned, the Federal Reserve has become data dependent again, and speculation about the future of the US monetary policy will continue this week. On Friday, all the attention will be on the jobs report, although we do have a few other important macro pointers earlier in the week from the world's largest economy to look forward to as well, including the ISM services PMI on Thursday. The jobs report is expected to provide us another strong reading. Analysts expect a reading of 700,000 on the headline front, which would be higher than the 559,000 we got in May. Average hourly earnings have beaten expectations in the previous 2 months, and another sharp rise could reignite inflation concerns. So watch out for that. This time, average earnings are expected to have risen by 0.4% month over month. Now, if jobs and wages come in line or around the expectations, then the ongoing Goldilocks scenario for the stock markets will likely to be kept intact, potentially leading to fresh all-time highs for Wall Street shares. But the key risk is if we see a very strong report or a very weak report. Okay, so if it's a very strong jobs report, this may not necessarily be good for stocks, as it could raise tapering concerns once again. But it will most likely boost the dollar, and that in turn could undermine things like gold and silver because they are priced in the US dollar, of course. But if the jobs report is very disappointing, then that could send yields and the dollar sharply lower, which in turn could provide support for gold and silver. So those are the two kind of extremes that we are looking for. But as I mentioned, if it comes in around the expected figure of 700,000, then that may not cause too much of volatility for the FX or gold markets, and it will probably keep the stock market supported. The other key event that I can see on this calendar is the OPEC Plus meeting. The key question is, will the OPEC boost supplies? I think the group may very well discuss production quotas for August and possibly beyond. But without the Iranian nuclear deal in sight, and in light of the rising Delta variant of COVID cases, this has raised the risk for weaker demand, which may very well discourage the OPEC to increase supplies more than expected at its meeting on Thursday. So if they make no changes to the previously agreed plan, oil prices may remain supported near the recent highs because of expectations of a tight market. But if they surprise and decides to restore production more aggressively, then that could catch the markets off guard, leading to a potential drop in oil prices. So do watch out for that. And of course, if oil prices go down or go up, for that matter, it will impact commodity currencies, in particular the Canadian dollar, the Norwegian krona. Obviously, oil stocks, if you're trading individual names, they could be in focus as well. And commodity heavy indices like the FTSE 100, there are lots of energy companies in the FTSE. That could be, the OPEC meeting could move the FTSE as well, indirectly. So lots happening this week. It has been a quietish start as we now transition to the charts.
Well, quiet and not that quiet.
Not
Because,
not not that quiet as well. Yeah.
the dollar has been rallying
Yeah.
over the past couple of sessions, and
Yeah.
we saw a relatively substantial move in oil yesterday, which is which continued today. That was triggered by an announcement, something that we have been talking about over previous webinars, that sooner or later we're going to come to a point where production is going to rise, and
Yeah.
it's very easy for many countries to basically tap into their reserves and put some more oil into the market
Yeah.
relatively quickly. And that is what we are now expecting to happen in the month of August, if I'm not mistaken.
Yeah. That certainly could be something to watch out for. Oil prices have more than doubled, haven't they, from where they were at the start of the year? And the key risk is if they start to go down because of increased production from the countries you mentioned. Also, there's the fact that the coronavirus cases are rising in the UK as well. This has raised the speculation that travel and tourism could be hurt in the summer months,
Right. Recovery,
which will be bad for demand, right?
recovery which we have been pricing in over the past,
Yeah.
well, 6 months really, has we have reached this point where the recovery in travel, transportation and travel has reached its kind of peak, I would say,
Yeah.
because currently the increase in the number of the Delta variant coronavirus
Yeah.
cases is hampering these expectations, and actually a reversal is occurring because um, people are starting, investors are starting to realize that um, the full recovery in demand in these sectors might take a while
Yeah.
if we ever reach previous levels, in fact.
Yeah.
Just because people have become so accustomed not to travel that, well, you're going to have to teach them to travel again. So that's going to take some time.
That's true. That's true. So obviously, prices have come down, as we mentioned. It's still a very strong trend, and a lot will now depend on what the OPEC will decide this week. And so far as oil prices are concerned, so far, I mean, despite the reversal at the start of this week, just have to put that into context. And if you zoom out a little bit, you can see that prices have been making higher highs and higher lows ever since everything bottomed out in March of last year. And whether or not this trend will continue will obviously depend on the macro considerations that we just discussed. But in the short term, the OPEC on Thursday is going to decide um, what direction oil price will take. And so in light of the the fact that the variant of the Delta variant of coronavirus is rising, that may discourage them from increasing productions more than expected. So, in fact, the OPEC Plus may help to keep oil prices supported, even if these strong oil is not necessarily good for the global economy. If you think about consumer nations like India, for example, it's gonna not only eat into the disposable incomes of people there, but also it's gonna put inflationary pressures on prices in India and other emerging market economies, and obviously developed economies that rely on oil imports. Yeah,
Arguably, that's also true for pretty much any economy in the world.
exactly. Yeah, yeah.
And
So
we
they
have,
have a job, they have a decision to make, because oil prices being this elevated is not going to be good for the global economy, I don't think.
and it's not going to be good for oil producers in the long run either.
Indeed.
The ensuing compression in demand
Yeah.
should forcefully, like you'd rather manage this market in a more tempered manner by bringing supply back online
Yeah.
rather than waiting for excessive prices to regulate the market
Yeah.
abruptly, uh, leading to some sort of crisis.
Indeed. Yeah. So they have a tricky job, to kind of balance the
Also,
market more
as the central
appropriately.
bank, right?
Yeah. Indeed.
So
Let's go back to the
to the currency markets, which are
yeah.
normally where we start with
Indeed.
uh,
And
the
and we start off with the dollar index normally, don't we? And let me just get rid of this bottom. Um, we normally start off with the dollar index, and the dollar index has risen because the euro dollar has fallen, and the dollar yen has risen in recent times, and other dollar pairs have pulled back as well. And it's all to do with, well, with the Fed. Really, they turned a couple of weeks ago at their meeting. They turned a little bit more hawkish, suggesting that two rate hikes could be on the cards in 2023, and that talks over tapering QE may have started, may start soon, and that has led to speculation that um, that the Fed may be the first major central bank to start tightening its belt. So that's puts upward pressure on the dollar. Is this going to be sustainable? Is the question. What do you think, Victor?
well, I think that until we actually see the tapering,
Yeah,
the dollar continues to be supported. I expect that to happen sometime towards the end of summer,
yeah,
probably at the annual Jackson Hole meeting of central bankers,
somewhere around here.
which is usually in the second half of August.
Yeah,
So, from a technical perspective, we managed to stay above the 200-day moving average, and that's something that definitely is worth paying attention to because
yeah,
it's the first time that the US dollar has managed to stay above this level since pretty much, yeah,
March, end of March.
I would say, yeah.
Yeah.
Well,
The
so
question is, can it
that
stay above?
time it just broke above it and then
Mm,
dipped back below it, and
yeah.
this time we saw it retested and it held two
Yes.
times in fact. So I would say that the technical picture here is favoring dollar bulls at least until we reach 93,
Which
where
is the previous high.
93.50 area.
Yeah.
Yeah, draw a trend line from the previous high around 94.50. I would say,
Sorry, I've drawn this wrong. Okay.
sorry, I meant
Uh,
December high through the May.
this high. Yeah.
So we have a trend line that is coming in at around 93.
Yeah.
And that should be tested at least.
Sorry, guys. I can see a question here from HH Hassan. What do you mean by tapering? Okay,
So,
so
yeah.
I'll let Victor answer this question. Go on.
All right. So tapering is basically what the Federal Reserve does is it is purchasing a predetermined amount of bonds, mortgage-backed securities. Like these are two types of bonds: government bonds and mortgage-backed securities. So that's to the tune of 120 billion a month, if I'm
Only.
not mistaken. Yeah.
Yeah,
So they're purchasing 120 billion a month of government debt and mortgage-backed debt on the open market. Sorry, not on the open market, but via
primary market.
dealers.
Yeah,
So basically, they have committed that they're to be purchasing these 120 billion every month for the foreseeable future.
yeah,
But 2 weeks ago, at the Federal Reserve meeting, they signaled that they might be raising rates, which means that they're going to start reducing and hence tapering the purchases of bonds,
yeah.
meaning they're going to print less money, if you want to put it in simple terms. So
Yeah, so
basically,
just to,
they're not going to be expanding the monetary base at the pace at which they have been
yeah,
expanding it before, which is why the dollar has reacted to this message and
yeah.
has started rallying.
Just to add, the Fed has always said that before they consider raising interest rates, they will reduce their asset purchases. So they're going to taper their asset purchases before they increase interest rates. And after the FOMC indicated via the dot plots, which are the economic and interest rate projections that each voter at the FOMC kind of projects, that showed that there will be two rate hikes by 2023, which means that bond purchases will have to be tapered before that. And as Victor mentioned, the Fed is probably going to set out the timeline at the Jackson Hole meeting or around that time to give us an idea when this tapering will take place. So most likely end of Q3, possibly early Q4 of this year.
Oh yeah, if they signal it in
Yeah,
Jackson Hole, I imagine that we might see a dollar peak at Jackson Hole, to be honest.
possibly. Yeah,
So,
I wonder though, because it's not the first time the dollar has rallied, and we had a attempt to break out earlier in the year. That failed, although we didn't make a lower low. Um, will the rebound hold this time? I have my doubts. And if you look at just from a purely technical point of view, the longer term picture of the dollar, zooming out to the monthly chart here, you can see that yes, we have broken the previous month's high, the high from May, like we had done in this period when the dollar broke higher for 3 consecutive months. That time it ran into resistance on the backside of the broken trend line. This time we are testing this shaded gray area where the dollar index had previously found support and resistance from. And we're retesting that zone once again. And although the short-term outlook looks bright, the longer-term outlook remains bearish for the dollar for as long as we hold within this gray zone or below it. Only when we go back above the broken trend line on the monthly will the trend turn objectively bullish for the dollar. So I would proceed with care here because the Fed's change of tone should have been expected. Economic data from the US economy has been improving for months. The markets have been speculating about bond purchases being tapered. It's not something new. The Fed is merely doing what they should be doing, reacting to data. And right now, the focus kind of remains on the reopening of the global economy and on reflation trade. So with reflation being in focus, investors might prefer racier currencies, like currencies where the central bank is expected to tighten its belt faster than the Federal Reserve. Currencies linked to commodity dollars, for example, the Canadian dollar being one. We may see, the Aussie and the Kiwi perform well as we head into Q3 and beyond. So yes, the dollar is looking strong right now. It doesn't mean it will stay strong heading into the second half of this year. But yeah, certainly we have seen some tentative bullish signals on all time frames on the dollar index. Let's move on and look at a few other major currency pairs. We can maybe the dollar yen, because obviously the dollar is showing relative strength. The Japanese yen is being a really weak currency because of expectations that the Bank of Japan is not going to tighten its belt anytime soon, right? So if the dollar is going to perform really well against any currency, it's going to be one of the currencies where the central bank is expected to remain dovish for a long time, such as the Japanese yen, Swiss franc, possibly the euro. So those are the currencies I would concentrate on if you're bullish on the dollar. And so far as the dollar yen is concerned, it has reached its main objective, which would have been the high from April, which was tagged a few days ago before price pulled back. Now price is testing support around I would say between 110.50 to the high of this hammer candle. If I zoom in a little bit, you can see that there was a hammer. We broke cleanly above it. Rounded retest of this level remains exposed at 110.35. That will be the next key support to watch on the downside if we get there. I would be careful if the dollar yen were to go on and break below the most recent low that was created at 109.72. Should that level break, I would turn bearish. So that's the line in the sand for me insofar as the dollar yen is concerned. A move below 109.70, which is about less than 100 pips away from where we are at the moment. So not a significant distance away, but volatility has been really kind of thin. A move below that would also push us below this bullish trend line that has been in place since really the start of this year. So that would be a bearish development should that happen. So that's the line in the sand for me. On the upside, we could draw our Fibs extensions from this high to this low. You can see the 127.2 comes in just ahead of the high from last year. And then 161.8 comes in slightly above it at 113. Those are the three objectives I would be looking for if we go back above this previous high that was hit in March. Okay. So there you have it. In terms of other currency pairs, the euro dollar is looking quite weak at the moment because fundamentally the European Central Bank continues to dismiss a speculation about tapering of bond purchases here. Inflation has risen in the Eurozone as well, but not to the same extent as the US. In any case, the ECB head, Christine Lagarde, last week said that inflation is going to rise further or is expected to rise further, but it's going to be temporary, meaning that the ECB is not going to alter its monetary policy because of a small rise of inflation above their target. Now, the euro dollar has broken its bullish trend line, and this is going to be important to watch. Are we going to continue to hold below the broken trend line? If so, the selling pressure is going to increase, I think, on the euro dollar. On the other hand, if we go back above the broken trend line, then that would be a very strong bullish signal in my view,
Uh,
specifically if you move above 120.
I would also pay attention to the monthly close,
Yeah,
which is coming in tomorrow. So yeah, uh, that
this is the
monthly,
monthly. Yeah,
yeah, that monthly close is going to give us a good lead of how many people might be caught short the dollar and
yeah,
basically rebalance into the next quarter,
yeah.
because it's also the final day of the quarter tomorrow. So we might
Indeed.
have a really volatile day today and tomorrow. So
Speaking of now that you mentioned that the short dollar positions,
yeah,
um, they closed from 37% open interest to 31% last week.
yeah,
This was the largest net purchase of the dollar since 2006. So last week, the dollar short positions were tapered quite substantially, according to research by Morgan Stanley. Something I came across earlier this morning. I wanted to mention that. So
yeah,
short positions on the dollar have fallen, which is potentially bad news for the euro, isn't it?
yeah. I think
Yeah,
so. It could continue to unfold this
yeah.
situation.
Um, that being said, the euro is still range band overall. It hasn't really moved much in this range since August of last year. It's been very slow moving currency pair. Despite what's
So HH Hassan is asking about the Canadian dollar. Can we have a look at that?
sure. What is Canada reporting this week? Um, we need.
Well, Canada is also reporting its non-farm
Are
payroll.
you sure about that? I don't think they are, to be honest,
Oh,
because
are they next week?
I
Because
think they might be next week. Yes, they do sometimes report a week after the Fed, a week after the US. On occasions, they report. On most occasions, they report um,
so
on the
the
same week.
GDP number is
Oh, it's
going.
the GDP numbers. Okay.
Yeah. So look, the GDP number is not that important, in fact, because
Yeah.
it has already been largely priced in. What we do, what made the Canadian dollar drop in recent weeks was actually the Bank of Canada that, after being very hawkish at its previous meeting, stated that they're going to take their time before they actually consider moving
Yeah.
on rates, and that that might be uh, that period, I mean, that time might be getting closer
Mm,
as they definitely have been talking about raising rates for longer than the Fed.
yeah.
However, for the time being, they chose to signal for the market not to be overtly optimistic on them moving on rates. So hence the Canadian dollar dropped down, or meaning that the
Or
US
the
dollar, Canadian dollar rallied
rallied. Yeah.
uh, to test 125 now. Yeah.
So the Canadian dollar is going to respond to oil price volatility this week. If oil
Oh,
continues to move higher, then this could provide downward pressure on the dollar CAD. Um, Technically, the dollar CAD reached its first resistance area in the shaded gray area in this light shading. This was the base of the previous breakdown. We kind of rejected that zone, went back below this shaded region, which was the 123.70 area, 124. We are retesting that area of potential resistance. So it's possible that we could see the dollar CAD go down again from this area. What I would be looking for is, if you put a line here, around somewhere here, it's, previously the daily candles were capped around this area. So this level is at 123, call it 123.25-ish. If price struggles to hold above that level, that would give you an indication that, in fact, prices are more likely to go down again. So today we are holding above, but that could change depending on the outcome of the macro events taking place this week, including the US non-farm payrolls and, as Hassan mentioned, GDP from Canada, which, as Victor mentioned, though, might not have too much importance insofar as the Canadian dollar is concerned. But in any case, keep an eye on 122, 23, 25.
So the leading currency against the dollar before this whole turnaround happened is precisely the British pound. We used to have this very
Yeah.
strong sentiment about the
Yeah.
pound
Yeah.
after all the news about Brexit were basically priced in to the market.
Yeah.
So what's happening there? I feel like
Yeah.
we're on much more shaky ground.
It does look like that, doesn't it, at the moment? What's happened in the UK is there was so much optimism about the reopening of the economy previously, and that got, I'm talking about full reopen, that got delayed a little bit because of the variant of COVID, the Delta variant. And right now, there are worries that, it's the numbers are rising still, and it's not really going down um, as much as the government would have hoped. So that has raised.
Isn't there some sort of misreading here? Because I see that the case numbers are rising, however, fatal cases are
Yeah,
not.
not
So,
yet. Usually, fatalities are they kind of lag, right? Rising cases. So
okay.
hopefully we won't see many fatalities from the new variant. And a lot of the population is now kind of, the adults. I think it's more than 70% now. I've lost count. They have been vaccinated, and more people are getting vaccinated against the virus. So hopefully it's not going to cause too much of damage in terms of not just lives, but the economy as well. But the fact that the Bank of England met last week, and they were equally as dovish as all the other major central banks in terms of when interest rates are going to rise in the UK, that
uh,
surprised the market a little bit as well. That caused the pound to break lower, and it stayed below the 140 psychologically important handle since. All told, price remains inside this red box, the prior kind of consolidation. So yes, it looks really bearish right now. It's still within its prior ranges. So, just because the trend line has broken, just because we've come down a little bit from the highs, does not necessarily mean that the trend has completely changed. It means that the trend has weakened. It does mean that we may see further weakness in the short term. But insofar as the longer term is concerned, I am not so sure that we would see significant falls for the pound against the dollar.
so what are the levels that we should be looking at?
Right. So I would be looking at, first and foremost, at the previous lows here at 137.87. So
Uh,
what could happen here is we may
probable.
break that level today. If we get a quick rejection from it, causing the formation of a hammer-like candle, either today or tomorrow, or later on in the week, that would be a first bullish signal that I would be looking for. If there's acceptance below this level, then the next level I'll be interested at is at the 136.86, which is the high from 2020, right here, this level. This level has been tested a couple of times already, and price has found support. And below that is the 200-day moving average. So we may come down to this area, and then a quick rebound is the sort of bullish price action I am going to be looking for. So, I would rather wait for that bullish signal to be printed first before turning positive on the cable. But even before that's created or potentially created, I'm not feeling too bearish on the pound because of my bullish macro thoughts on the cable. If that makes sense.
All right. So
Yeah,
shall we have a quick look at gold and indices?
sure. Let's start off with indices. And the Nasdaq is one particularly strong index to look at. Yields have gone down in recent days. Well, they haven't really gone down, but kind of stayed below the pre-FOMC levels, if you like, at 150 in terms of the US 10-year bond. So when yields are not going up, it tends to boost the appetite for stocks that have low yields, namely growth stocks. Plenty of those in the Nasdaq. I think there was some story about Facebook as well, and a few other technology companies yesterday that caused the index to break out to new all-time highs. So the Nasdaq is looking really strong at the moment. It looks like that strength is going to continue for a while yet. We don't, expect, or I certainly don't expect to see a immediate turnaround from these levels. I was thinking before that, that the Fed tapering QE or signaling to taper QE is going to cause panic. It didn't. So what's going to cause the Nasdaq to turn around is if inflation concerns reignite again, and at the moment that doesn't look very likely either. So I think the dips are going to be supported on the Nasdaq going forward until probably a couple of months from now when
Until
central
something.
banks, yeah, indeed. So this looks strong, but the same can't be said about the other indices. If you look at the FTSE struggling a little bit around the 21-day exponential, hasn't really broken higher. The German DAX index is looking a little bit more bullish than the FTSE. It has reclaimed this broken trend line. There are more technology stocks, I think, in the DAX than in the FTSE. There's not many in the FTSE anyway. Today, we are breaking outside of this short-term consolidation range, which is a positive sign. If we close above the trend line, then I think the all-time high will be challenged, possibly tomorrow or maybe later on today, ahead of more gains, later in the week. Are you looking at any particular index, Victor?
Well, I've been actually keen on the S&P 500. Is breaking out as
Yeah.
now.
Yeah.
And basically, since this index has a relatively balanced composition between technology, growth, etc.
Yeah.
The sentiment is pretty much reaffirmed by the price action on this end.
Yeah.
So we might see one final melt up in stocks before, as I said, something happens and something.
Yeah. People are
excessively bullish.
Excessively bullish, and because there's so much liquidity going around in the markets.
That's always a worrying sign. Like
yeah.
Normally when you hear people talking in one direction.
So, yeah, that's something to
be
always be worried about. Yeah.
So we have a question from H. Hassan, which is inflation going up to compensate for the lower demand? No, not really. Inflation is going up. Actually, well, the more prices rise, the lower the demand.
Yeah.
So counterintuitively, what is happening right now is that those companies that have any pricing power are shifting it over to the consumers of their products to compensate for the periods of time that when they didn't have enough income. So basically, prices are rising because companies are trying to compensate for the previously missed opportunity to sell their stock, like their products. What I mean is what I mean, not their
Yeah.
shares.
So gold is looking quite weak at the moment still. It dropped quite sharply after the Fed signaled its intention to raise interest rates twice in 2023. And the dollar rallied as yields uh, rose a little bit, but more to the point, it was because of the strength of the dollar that caused the price of gold to go down. Technically, gold has found some support around the right shoulder area of this inverse head and shoulders pattern. However, it's not doing what it should be doing, which is to go up. Right now, it's still looking like it wants to break lower, and so this raises the question: is this just a pause before the next leg lower, or is it creating the right shoulder area? Well, it's not really doing a good job of creating the right shoulder at the moment.
Yeah,
We need to see decisive bullish price action in this zone before one can become
yeah.
confident that the
It
price of
looks
gold is
like
going to go higher.
it's going to retest the lows at 1760 something.
1676 is the low,
No, I'm saying the recent low
the
from
recent low. Yeah.
the recent
Uh,
low 1760-ish, and
something like,
then
yeah,
we have yeah
1761. Yeah.
yeah, and then we have another low which is from back in April.
Yeah.
At the end of April, we had a uh, at the end.
End
So
of April.
yeah, yeah,
This
that
line.
yeah, 1756 is probably the next stop because we have paused at that level
Yeah.
before a couple of
Yeah.
times, while the head that you have drawn between March and April was forming.
Yeah.
So basically, these are the immediate levels to look at,
Yeah.
and if those give way, uh, there is nothing stopping it from testing the uh, previous previous low for the
Yeah.
year, March.
Yeah.
So,
So I think it's because the NFP week, non-farm payroll was weak. I wouldn't necessarily expect a breakout or breakdown until the jobs report is published. So, although it's looking quite weak today, it may well bounce back and go back within the existing ranges ahead of the jobs report. I think people will be happy to take quick profits here and there rather than commit to one particular direction in a NFP week. So, yes, it's looking quite weak. It's testing support. You don't want to be selling it into support, right? So if you're looking for a bearish trade, maybe it's best to wait for that breakdown to happen, then uh, possibly look to retest, sell on the retest. Or if you're waiting for a bullish price, bullish breakout, then perhaps waiting for the price action may make sense. In the interim, you could obviously trade on the lower time frames while it's bouncing between support and resistance. But yeah, the key point is that it's testing support, and right now it's looking weak. But depending on the outcome of data this week and other macro events, it could well bounce back. So let's have a look at cryptos. We talked about crude oil, didn't we, at the start of the webinar? For those of you who missed it, Bitcoin is looking a little bit more bullish as we start as we head towards the end of the month and quarter. It has repeatedly found support around the 30,000 mark. And that level remains the line in the sand insofar as the direction is concerned. While we hold above 30,000, I think the bulls are edging it only ever slightly at the moment. And they are putting up a really good fight here. Price has broken above 35,000, which was the next level of resistance. If it holds above 35,000, a previously support, that would be our first bullish indication, because it will have also taken out this bullish bearish trend line and moved us back above the 21-day exponential moving average. So that would be a first bullish indication. What I would like to see next from a bullish point of view is a rally above the 40,000, specifically this high here, because that was the last high created prior to price making a lower low relative to this low. So if that high gets taken out, we will have created our first higher high. Therefore, the bias would, the bearish bias would completely become invalidated at that point, in my view. So a move north of 41,000 is going to be bullish long term. In the short term, if Bitcoin can stay above 35,000, I think that would be positive. Ethereum is the other cryptocurrency we keep a very close eye on, or Ether, I should say. Like Bitcoin, it has found repeated support around its own support around 1850-ish, 1800. It has broken this bearish trend line, providing as a short-term bullish price character here, taking us above the 20,000, 2,000 level, which was previously resistance and support, short-term resistance here. Now we're back above it. So the path of least resistance in the short term is back to the upside insofar as this crypto is concerned.
So Alex wants us to have a look at Cardano. If you can pull up that chart.
Is that the one? Yeah.
One.
So this particular coin is it's quite popular, isn't it? Like a lot of people are talking about it, and it has been consolidating for a while, like all the other cryptocurrencies. But in the last couple of days, like Bitcoin and Ether, it has started to break to the upside, taking out this bearish trend line, and now it's testing the base of the previous breakdown around this zone here. And so what we need to see next from a bullish point of view is if it can move above this shaded region on a daily closing basis. I think that would be a bullish signal. And specifically what I'm looking for is a move north of this. You see this big bearish candle here. If we move above the high of that candle, it would be the first real bullish signal, because surely there should have been some downside follow through when this candle was formed, right?
Yeah.
But if instead we go above that candle, then that would indicate to me that perhaps people are happy to stay long, or they were happy to buy that dip, which would obviously be a positive sign from at least from a technical analysis point of view. So a move north of 143.64 is what I'm looking for. Guys, if you have any other questions, please ask us now, because we have run out of time. And but yeah, there's time for one or two more questions before we let you go.
Yeah. So yeah, just to sum up on the question that H.H. Hassan had, Yeah, assuming that you had meant lower demand by the previous times during which companies weren't making much money, that is precisely why prices are rising. How long can prices rise before demand falls again? That is the best. That is the $1 million question, really, if not trillion.
There's another question from Alex who asks, do you expect Bitcoin to set the trend for crypto markets, or the altcoins are strong enough not to follow Bitcoin? Would you like to take that question, Victor?
Sure. I don't think that at this point in time altcoins are ready to decouple from Bitcoin.
Yeah.
It's the only cryptocurrency that has some level of institutional adoption, and the biggest amount of money is continues to be poured into Bitcoin.
Yeah.
The network of Bitcoin users and whales and what have you is like this is the only currency that can a cryptocurrency that can accommodate a high enough amount of assets. The other cryptocurrencies are not liquid enough, which is an issue for institutional adoption. So yeah, I think that for the time being, Bitcoin is going to continue to be setting the trends in the crypto space.
Excellent. Thank you so much, guys, for attending today's webinar. For those of you who watched us live, thank you so much. And for those of you who didn't watch us live but are watching the recording of this, please consider joining us live next time. You can do that by going to our website, thinkmarkets.com. Go to Market Analysis, live webinars, and here you will see a list of upcoming webinars, which you can register by clicking on the register button. Okay, we have another webinar coming up. Well, 2 more webinars, haven't we, Victor, this week?
Yeah.
Tomorrow, 1st of July, Victor is going to be identifying key
Sorry,
gold trends.
sorry, that's not tomorrow. That's the day after tomorrow.
My apologies. Yeah, so tomorrow is Wednesday, 30th.
Yeah.
First,
Oh,
1st of
Thursday.
July is on Thursday. So that's on Thursday, 1st of July. Sorry about that. On Friday, a day later, we have the usual non-farm payrolls preview webinar. This happens every month when we have the day when we have the US jobs report. So we're going to preview the pre-NFP data that had been released, that are going to be released this week, and provide our thoughts on how stocks, the dollar, and gold are going to trade after the jobs report is published on Friday. So make sure you join us for those, and you can join us by clicking on the register button for each. See you guys in those webinars. Take care.
Take care. Thank you for attending.